Ever wondered how businesses account for mergers and acquisitions? Well, that's where the International Financial Reporting Standard 3, or IFRS 3, business combinations comes into play. This standard outlines how businesses should account for the financial effects of mergers and acquisitions. It's a set of guidelines that companies follow to provide transparency and consistency in their financial reporting. So why is this important? Understanding IFRS 3 is crucial for businesses and accountants alike. It ensures that financial statements reflect the true cost of these transactions and gives stakeholders a clear picture of a company's financial position. Whether you're dealing with the acquisition of a small startup or a merger with a major corporation, IFRS 3 helps you navigate the financial implications. So, are you ready to unravel the mysteries of IFRS 3? Let's dive in. First things first, what exactly is a business combination? Well, in the world of financial reporting, we use the International Financial Reporting Standard 3, or IFRS 3, to define a business combination. According to this standard, a business combination occurs when one entity gains control over one or more other businesses. It's a significant event, often involving mergers or acquisitions, that can shape the future of the involved companies. The key here is the concept of control. This isn't about owning a majority of shares or having the most board members. Instead, control is about the ability to direct relevant activities of the other business. So whether you're merging with a competitor, acquiring a startup, or joining forces with a complementary business, if you're gaining control, you're entering the realm of business combinations. Understanding when a business combination occurs is the first step in applying IFRS 3. Now, how do we figure out the acquisition date? That's a great question. The acquisition date is a pivotal point in the process of a business combination. It's the date on which the acquirer actually gains control over the acquiree. So how do we determine this date? Well, it's not necessarily the date when the deal is agreed upon or even when the transaction is closed. Instead, it's the date when the acquirer starts to call the shots, when it begins to direct the relevant activities of the acquiree. This could be before, on, or after the contractual agreement date. The acquisition date is crucial because it kicks off the acquirer's accounting for the business combination. It's the starting line for recognizing and measuring the identifiable assets acquired, the liabilities assumed, and any non-controlling interests in the acquiree. Remember, the acquisition date marks the beginning of the acquirer's accounting for the business combination. Next, we need to recognize and measure the assets and liabilities involved. This is a critical step in the process of a business combination as per IFRS 3. Let's break down this process into more manageable bites. Firstly, we need to identify the assets and liabilities that are part of the business combination. These could include physical assets like buildings or equipment, intangible assets like patents or trademarks, or financial assets and liabilities. The key here is to identify assets and liabilities that are part of the acquired business and can be separately identified and measured. Once we have identified these assets and liabilities, we need to measure them. This is done by determining their fair value as of the acquisition date. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It's not about what the acquirer thinks the asset or liability is worth, but rather what the market would pay for it. This step also involves recognizing any non-controlling interests in the acquiree. Non-controlling interests represent ownership interests in a subsidiary not attributable, directly or indirectly, to a parent. These interests need to be measured at their fair value or proportionate share of the acquiree's identifiable net assets. It's vital to note that the assets and liabilities recognized must be those of the acquiree. The acquirer's assets and liabilities are not part of this measurement process. This recognition and measurement process provides a snapshot of the financial situation of the combined entity at the acquisition date. It sets the stage for subsequent accounting and provides valuable information to stakeholders about the financial implications of the business combination. Remember, this process requires careful judgment and often involves significant estimates and assumptions. It's not always straightforward, but it's a crucial part of the business combination accounting process. Getting the numbers right here is crucial to accurately reflecting the financial impact of the business combination. It's about providing a clear, transparent picture of the financial situation emerging from the combination, which is vital for informed decision-making by all stakeholders. What happens when the cost of the business combination exceeds or falls short of the fair value of the identifiable net assets? This question brings us to the concept of goodwill and a gain from a bargain purchase. When you tally up the cost of a business combination and it surpasses the fair value of the identifiable net assets acquired, you've got goodwill. This is a little like paying for potential, the unquantifiable aspects of a business that could lead to increased profits in the future. On the flip side, if the fair value of the net assets acquired outstrips the cost, you're looking at a gain from a bargain purchase. This is essentially a financial windfall, a positive gain recognized in profit or loss. So whether you're dealing with goodwill or a gain from a bargain purchase, recognizing it correctly is key to the financial representation of the business combination. This ensures transparency and accuracy, providing stakeholders with a clear picture of the transaction. So, we've recognized and measured the assets, liabilities, and goodwill. What's next? Well, let's dive into the world of measurement period adjustments and the subsequent measurement of goodwill. In the whirlwind of a business combination, it's possible that the initial figures we've calculated may need some fine-tuning. This is where measurement period adjustments come into play. Think of it like adjusting the focus on a camera lens. You want the picture to be as clear and accurate as possible. So, if new information comes to light about facts and circumstances that existed at the acquisition date, and if that information would have affected the measurement of the amounts recognized, we adjust those provisional amounts. But remember, this measurement period cannot exceed 1 year from the acquisition date. Now let's turn our attention to the subsequent measurement of goodwill. After the dust of the business combination has settled, goodwill needs some attention of its own. Unlike other assets, goodwill is not subject to amortization. Instead, it's tested for impairment at least annually. Impairment testing is like a financial health checkup for goodwill. It ensures that the carrying amount of the goodwill doesn't exceed its recoverable amount, the highest amount that could be obtained from the asset in an arm's-length transaction between knowledgeable, willing parties. But what if there are signs that goodwill may be impaired more frequently than annually? Well, then it's time to roll up our sleeves and conduct an impairment test. If an impairment loss is identified, it's recognized immediately in profit or loss. And remember, unlike other assets, once impaired, goodwill cannot be subsequently reversed. Regular adjustments and impairment testing ensure the continued accuracy of the financial representation of the business combination. It's about maintaining clarity and accuracy in our financial picture, because in the world of business combinations, every detail counts. What about contingent considerations and disclosures? Let's delve into that. Contingent consideration is typically a part of the purchase consideration in a business combination, which is dependent on future events or outcomes. The value of this contingent consideration can change over time based on the occurrence or non-occurrence of certain future events. According to IFRS 3, contingent consideration is recognized at fair value as of the acquisition date. Now this is where it gets interesting. Contingent consideration is not a one-time deal. It is remeasured to fair value at each subsequent reporting date. Any changes in fair value are generally recognized in profit or loss, making it a dynamic component of the business combination. But it's not just about recognizing and measuring. It's also about communicating this information effectively. That's where disclosures come in. IFRS 3 mandates extensive disclosures about the business combination in the financial statements. So, what do we disclose? Well, a lot. The reasons behind the business combination, the assets and liabilities acquired, any goodwill recognized, and of course, the contingent consideration. The disclosures need to be comprehensive, clear, and concise. They should provide a complete picture of the business combination to the stakeholders. This includes information about why the business combination happened, what assets and liabilities were acquired, and how much goodwill was recognized. And let's not forget about the contingent consideration. It's important to disclose how it was determined, what conditions it's subject to, and how its fair value will be measured in the future. In essence, these disclosures help in painting a clear picture of the business combination. They provide stakeholders with all the necessary information they need to understand the financial impact of the transaction. Remember, the goal of financial reporting is not just to present numbers, but to tell a story. A story that is transparent, accurate, and easy to understand. And that's exactly what these disclosures aim to do. Transparent disclosures are key to providing stakeholders with relevant information about the business combination. We're almost there. Let's talk about transition requirements, special considerations, and tax effects. Transition requirements come into play when the acquirer had a previous equity interest in the acquiree before gaining control. In such scenarios, the acquirer needs to remeasure any previously held equity interest in the acquiree at its acquisition date fair value. Any resulting gain or loss should be recognized in profit or loss. Next, we move on to special considerations for business combinations achieved in stages, also known as step acquisitions. Here, the acquirer should remeasure any previously held equity interest at its acquisition date fair value, recognizing any gain or loss in profit or loss. The acquirer then applies the acquisition method from the date it obtains control. Now, let's explore the tax effects of a business combination. These are primarily concerned with deferred tax assets and liabilities. It's essential to recognize and measure a deferred tax asset for deductible temporary differences, unused tax losses, and unused tax credits. This applies even if the deferred tax asset exceeds the fair value of the net identifiable assets acquired. If this is the case, the excess is recognized as part of the bargain purchase gain. However, the acquirer should only recognize a deferred tax liability for taxable temporary differences associated with goodwill if the goodwill is deductible for tax purposes. If the goodwill is not deductible for tax purposes, the acquirer may not recognize a deferred tax liability. Instead, it recognizes the resulting deferred tax asset, if any, as part of the calculation of goodwill. The tax effects of a business combination can be complex and may require the expertise of a tax professional. However, understanding these tax effects is crucial for accurate accounting and can provide valuable insights into the financial impact of the business combination. These considerations ensure comprehensive coverage of all aspects of the business combination. That was a lot to take in, wasn't it? Let's take a moment to recap the essential points. We've explored the complex world of IFRS 3, business combinations, starting with the identification of a business combination, followed by determining the acquisition date. We delved into recognizing and measuring identifiable assets and liabilities, and how to handle goodwill or a potential gain from a bargain purchase. We also touched base on measurement period adjustments and the subsequent measurement of goodwill. We then moved on to the recognition of contingent consideration and the importance of comprehensive disclosures. We wrapped up by discussing the transition requirements, special considerations for business combinations achieved in stages, and the consideration of tax effects. Each step is a crucial piece of the puzzle, helping to ensure accurate and transparent accounting for business combinations. Mastering IFRS 3 is a crucial skill for any accountant. Stay tuned for more insightful guides. Don't forget to like and subscribe to our channel.